What causes asset bubbles to burst for investors? Imagine a balloon filling up with air until it can't hold anymore. That's what a financial asset bubble looks like. Prices soar beyond what the actual value justifies. But what makes that balloon pop? Let's break it down. An asset bubble happens when the price of an investment climbs way above its true worth. This often happens because investors get caught up in excitement or speculation, rather than solid facts. When everyone starts buying because they think prices will keep rising, demand pushes prices higher and higher. This creates a cycle of rising prices that feeds itself. But bubbles don't last forever. One common reason they burst is a shift in investor sentiment. When investors start doubting that prices will go up anymore, they begin selling. As more investors sell, prices drop quickly. This can turn into a panic where everyone rushes to sell, making prices fall even faster. Another big factor is the withdrawal of easy money. When interest rates are low or borrowing is cheap, investors borrow more money to buy assets. This borrowing fuels the price increases. But if central banks raise interest rates or tighten lending rules, borrowing becomes more expensive. Fewer people can afford to buy, so demand drops and prices fall. Leverage or borrowed money also plays a role. Many investors use loans to buy assets during a bubble, hoping for quick profits. When prices start falling, these investors face margin calls, meaning they must sell assets to repay loans. This forced selling adds to the downward pressure and accelerates the burst. Sometimes the story that justified high prices no longer makes sense. For example, during the dot-com bubble, investors believed internet companies would revolutionize business and make huge profits. When it became clear many of these companies were not profitable, confidence evaporated, and the bubble burst. For adults managing investments, spotting warning signs is key. Rapid price increases, widespread excitement, stories justifying high prices, and fear of missing out are all signs of a bubble. Diversifying across different asset classes can help cushion the blow if a bubble pops. Staying disciplined and sticking to a long-term plan can prevent chasing after quick gains that often lead to losses. In the end, bubbles burst when investor enthusiasm fades, credit tightens, leveraged investors are forced to sell, or the story behind high prices no longer holds. Keeping informed, maintaining discipline, and spreading investments across various asset classes are smart moves to handle these risks.